Hey everybody, thanks for tuning in. We're going to give it a couple more minutes, let a few more people to hop on. There's always a couple stragglers here, so we'll probably give it until about 7:35 Central. So give it a couple more minutes. Thank you.
Hey, good evening.
Hey everybody. Yeah, and if you want, put all your contact info in the chat. I think the biggest thing about this is the networking component, right? So me and Ronny and Anton will kind of go through and, kind of get a little bit of a panel going and kind of talk about, the state of the market. But we ultimately want some Q&A as well. So just be thinking through some questions that you might have. And then at the end of this, we'll do a couple breakouts, because I think that's the most impactful part of this whole thing. But we're going to give it 2 more minutes and then we'll get kicked off here.
Put in the chat where everyone is from. Would love to see where everyone's from. And then, yeah, if y'all have any questions or anything like that, be sure to put into the chat. We'd be happy to answer them.
Absolutely. Yeah, and I think it's always nice to kind of see where everybody's kind of coming from. Sometimes we're pleasantly surprised. Marketing works, I guess, right? So
we've had people attend from all over the world.
I know awesome. It's crazy. It's crazy. So
Ben, we can't see you.
Yeah, let me go ahead. Boom. I got my air traffic control tower, headset on there. But let's see here. I'm gonna give it 1 more minute. But again, thanks everybody for tuning in, especially on a Wednesday night. I know everybody has family and other obligations, but try to be respectful. So just I'll kind of give everybody the lay of the land here, and then I'll introduce myself. But we'll come through. We'll do a panel, a little bit of a just state of the market, how are things are going, what me, Anton, and Ronny's perspective is, what we're doing to adapt to the new kind of changing environment that we're seeing ourselves in. But I think again, the most impactful part of this is going to be the open Q&A. So if you have questions, doesn't have to be about what we're talking about. It can be just real estate in general. It can be, building teams, partnerships, whatever it might be. Please put those into the chat and we'll go through those at the end. And then after that, we'll have a breakout, which will probably be 10 or 15 minutes. And then depending on who's still around, I might just keep it open after that. But we typically try to wrap up no later than, I'd say probably tonight it's going to be no later than 8:45 or 9. So just to give everybody some idea of time frames. So there is still people coming in. So I'm going to give it just a little bit longer. All right. Well, I think we can go ahead and kick off. So thank you everybody for tuning in. This is the Texas chapter of the Multifamily Masters. We've been doing this, man, Ronny, Anton, how long have we been doing this for? I feel like we've been doing this webinar for like 2 years.
It's over 2 years. It'll be 3 years in a couple of months. 2.5 years right now.
Yeah. So I mean, we've been doing it a while. So I'm Ben Suttles. I'm one of the managing partners of Disrupt Equity. My business partner is a gentleman named Feras Moussa. He is currently on a flight back from Tampa right now, so he will not be joining us. But we syndicate multifamily. We're looking to develop multifamily as well. Currently have about 3,000 units, bought and sold, probably closer to 4,500 units all in. Assets under management is probably around 500 million at this point. And we do have a property management company. So, we like to kind of call ourselves vertically integrated as well. But, been doing this with our DFW partners, Mr. Ronny Phillip, Anton Mattli, and John Monteiro. John's out tonight. He had another business obligation as well. But they have been our partners on the Texas Multifamily Masters webinar series that we do every month. Typically we'll have great speakers, we'll do panels and open Q&A like this, but it's just another opportunity for people to network, right? And that's ultimately what it's all about. It's relationship driven business, and we try to provide those platforms. So, happy to kind of kick things off, but I'll go ahead and turn it over to Ronny. Want to go ahead and introduce yourself?
Sounds good. Thanks, Ben. And thanks everyone for attending. My name is Ronny Phillip. I'm one of the co-chapter leaders of the Dallas chapter of Multifamily Masters. My company is the Kingly Group. We're a real estate private equity firm based in Dallas, Texas. We focus on Class A and Class B multifamily across the Sunbelt region. So far, we've bought 948 units across Texas, Georgia, and North Carolina. And really excited for this panel. I'll pass it on over to Anton.
All right, Mr. Anton.
Thanks, Ronny. Hi, Ben. Hi, everyone. Anton Mattli, and I'm the co-founder and CEO of Peak Financing. We arrange financing for commercial real estate, and a big chunk of that is multifamily. So we are extremely embedded in that space, including syndicators. So we help a lot of syndicators with their financing and the structures they have in place. I personally have been investing in commercial real estate and multifamily for almost 30 years. So whatever we bring to the table, we always have the hat from an investor perspective on too. So we understand all the pain you go through, and we help to alleviate that pain as much as we can.
Heck yeah. And I think right now it's having good partners, like Anton and Ronny on the team, that's important, right? People that have experience. I think that's a good segue into kind of what we're going to, it's not necessarily a theme that we're going to be going through. It's not all doom and gloom. It's more so, I'm a big proponent of there's deals in every part of the market cycle, right? And really people are going to be like, well, are we at the peak? Are we at the trough? Where are we at? I think the problem with today's market is nobody really knows. We're in uncharted territory, folks, right? All we know is that interest rates and inflation are up, right? How far up those go, do those plateau, do those come down? I think time will tell, right? So, I'm gonna pose the first question to Mr. Anton, right? What do you see happening? And this could be, you do debt and equity, and obviously, you've put deals together too, right? What do you see happening in the multifamily industry? And I won't pin you to the wall, but let's just say over the next 6 months, right? From interest rates to leverage to lenders that are in the market, right? What is that? Is that going to be completely stalled out? Is that going to be something that, will eventually get a little bit better? What's your thoughts on the next 6 months? Because I don't want to pin you to the wall and tell me what's going to happen in 2 years. Nobody really knows. And probably nobody really knows about 6 months, but I'm going to at least put it out there.
Yes, obviously we never know whether the next shoe drops and everyone is freaking out, right? But I think what we have seen in June was really a freak out of the market. Even though everyone was expecting the Fed to raise rates, everything was happening. The 75 basis points were happening, and unfortunately the market was freaking out. Including all the bridge lenders on which a lot of the multifamily buyers, as we know, depend on. Over the last 24 months, 90% of all multifamily acquisitions were financed with bridge loans. Even if it's a bank loan, it's still a bridge loan. And so they suddenly freaked out back in June. Now we are back with the 10-year Treasury at the levels where we were in June, but the lenders are much more calm. They have already seen that. They are prepared for it. The investor market, all these deals, majority of these deals are being sold into the marketplace. They are aware of this, and as long as the deals are priced properly, there is an investor market for these deals. So I do not see that we have an issue of lenders going away over the next 6 months, except obviously we have another massive hiccup in the market. But as long as we have these rate increases as everyone anticipates. We see price increases. We see obviously terms adjusting accordingly, but it's definitely done in a way that is not the market freaking out. Right, that's on the lending side. I would say on the transaction side, there I definitely see a problem because buyers have to have lower prices with the borrowing cost that they have now to face, and sellers are not willing yet to lower the prices to match that, right?
Yep.
The reality is, yes, rents have increased, but that has not really translated into the NOI that would justify the same price on these properties. So I think that's where we likely are going to see kind of a stall, a lower amount of inventory. And that is kind of a normal process that we see all the time, right? Borrowing cost goes up, affordability for the investors that buy these properties goes down, yet the sellers haven't adapted yet. It's actually almost very similar to what we see on the single family side, where once you have certain rates, buyers walk away or they cannot do it anymore. And I think we have the same situation on the buy side by investors, right? They just need prices that make sense.
And I would add to it, and Ronny, I'm going to come, there's a variation in this question I'm going to ask you here, man. But I would also add that, you know, sellers that are smart realize that they might not get the pricing that they want right now. And so if they can hold on to it, they're going to hold on to it, right? You know, it's really only those people that are kind of coming up on a term, or, you know, they got to close out their fund, or there's something that's forcing them to sell right now, are the only really people, or the people that are in trouble are really the only people that are selling. You know,
Yes.
Otherwise you wouldn't want to sell right now. I mean, you know, unless something was baked a long time ago. You know, we're selling a deal right now, but it was baked a long time ago, right? You know, so from our perspective, it's like, okay, let's just get it done. But I would probably caution anybody about going to market right now. You know, and the brokers are telling you right now too. Everybody thought that it was like, oh, after Labor Day, it was all going to kind of open up. They're telling us, now it's after NMHC, which is in January. You know, and I don't know if they're just sandbagging on that. Who knows? But something to kind of take into consideration. So
that's definitely the case, right?
Yeah.
Now, I think certainly when we look into the syndication space, the challenge a lot of syndicators have, right? And we talk also to a lot of passive investors that provide us feedback on the returns and cash on cash checks that they are getting. And a lot of them have not really been performing that well, and they get pressures from the passive side to sell, particularly when the time is coming. But even in those situations, you have to balance that with the question when you really want to go to the market, right?
For sure. You know, so Ronny, kind of a variation on the questions, right? I mean, you raise a lot of money, you're doing deals, right? What is the equity sentiment out there, right? Your LPs, where are their heads at? You know, especially what are you seeing over the next kind of 3 to 6 months? You know, as far as people kind of getting into deals on the LP side.
I think it really depends on your equity database, right? If you have a very warm investor database and you have really good relationships with them, I don't think it's as much of an issue. But I think it just depends on your approach. I mean, so far, it's been a record-breaking year for us. I mean, we have, let me see, we just closed 376 units, and then we have another 607 under contract to buy, and then one sale. So, I mean, it's been pretty active. I mean, we've mainly raised from individual high net worth investors, and we've been getting pretty good feedback. I will say it is a little bit harder, just because, you know, stock market's down. When you see your stock market portfolio go down a significant amount, people start to get a little bit worried. From the institution side, because we're starting to get into that space as well, we've seen a lot of groups go on pause. A lot of the New York-based private equity groups we've built relationships with have gone on pause, haven't been accepting new managers or new operators. So it's been a lot different. And I'm seeing a lot of preferred equity structures in deals right now. And that's been very interesting to see. A lot more syndication groups are getting used to that, and that type of those type of LPs are getting more comfortable being behind the pref as well, because the pref essentially caps a certain part of the capital stack to a certain return. So I mean, either or.
All right. So, I know what you're talking about, but we gotta talk to our audience a little bit. So let me ask Anton. So Anton, explain in simplistic terms, my friend, what is pref? What the heck is Ronny talking about? And what's good for the LPs and what's bad for the LPs? So, because I think this is an interesting shift, that I've been seeing over the last call it even 12 months. It's, where people have shifted into, let's do pref in our deals. We saw enough demand that we actually raised a fund on it, but what is that? And so Anton, can you kind of explain?
Yeah, so maybe just also explain why that has started to get on much more traction. Until 6 months ago, it was normal that virtually every acquisition deal you could get a bridge loan at 80% LTC, right? And that was typically sufficient then to fill the remaining 20% with senior equity, right? Some of the groups already added another pref equity piece to it, but typically most of them just said, okay, let's fill it up with 20% senior. Now, the problem is that a lot of bridge loans now come in at 65 to 70% LTC. So now that 20% has now grown to 30, and obviously that makes it much more attractive to actually spend the effort to go for pref equity. So now, what is pref equity? It is behind the senior debt, right? So the senior debt obviously has a first lien on the property. Pref equity does not. So pref equity is still, as it is called, preferred, is equity. However, the name preferred, as the name preferred implies, it is in a preferred position, meaning that it is repaid first before the seniors are being repaid. So that's the most traditional way of pref equity. Some pref equity might be just having a pref return without having a preference in repayment of the capital. But in a majority of times, the repayment of the capital of the preferred equity comes first before the senior equity.
So let's pause there. I want to drive this point home, right? Because I think a lot of LPs get into these deals and they don't really know what's happening here. Right. So the one thing that I want people to understand is there is some benefits to pref equity, both on the LP and the GP side. So I'm not this is not a knock on it. We've used it. We've also deployed it in other people's deals. Right. But the one thing that people need to understand is that the pref, so you got senior, pref, then common equity. This is where all your LPs for the most place lie, right? So if you've got a third party pref equity provider here, they're in a better spot on the capital stack than you are, right? And so what does that mean? That means that they get paid first and they get paid back first. So if anything goes wrong, the market shifts on you, your valuations go down, you don't hit your targets, whatever it might be, guess what? They're sitting in a better spot than you are. So there's a fair amount of risk that you have to bake into, not a lot, but there's still some, right? That the common equity people need to take into consideration when they're getting into deals that are like that. Now, there's also two other things I want to mention too. There's a hard pref and then there's a soft pref, right? That at least this is kind of how I describe it. I don't know if this is really an industry term or not, but the soft pref is you have different classes of shares. People have probably been seeing that over the last 12 to 24 months. It's gotten more in vogue. But when I started off 7 years ago, nobody was doing that, right? Now it's like, let's get creative. And really that those different tiers are sometimes pref, right? Where they're capped, but they might be sitting above common equity. What I'm talking about hard pref is when you have a third party Wall Street firm that's giving you a pref equity check. Guess what? So they're going to have their clutches into that GP, that syndicator, right? And they might have rights over some of the decisions that are being made. They might have rights to take over the property if the things go wrong. And and ultimately they're going to enforce their position on the capital stack and make sure that they get paid first and get paid back first. So something to take into consideration, right? I don't know anything else to add there, Anton. I mean, I wanted to drive that home.
Yeah, no, that's correct, right? So it's you almost have to, from a common equity perspective or an LP perspective, you almost have to treat it as a higher leverage in the deal, right? Yes, it's not leverage per se, but you're still behind, right? So ultimately, you're not going to be having to pay back a debtor, but you're still going to pay back that Wall Street firm or whoever it is within that preferred equity position, right?
So tell people the distinction between mezzanine debt, and pref equity. Right. I think that there's a lot of misconceptions about what those things are. Can you kind of give some distinction or some differences between the two?
Yes. So mezzanine debt is really debt, right? However, it's debt at the corporate level. It's still not a lien on the property, but it's real debt, right? From a common equity perspective, as a passive investor, they also have pretty significant rights in taking over the GP position, right? Much more so than typically the pref equity has, unless you have a Wall Street group that has so many rules already built into their pref equity that it almost mirrors all the rights that you would have typically as a mezz lender. But you have to anticipate if things go wrong or the management is just not performing well, that group that is providing the mezz financing, that they are able to take over the GP role, right? Yep. But from a common equity perspective, there is not really much of a difference there, right? You're still behind, whether it's that pref equity bucket or whether it's the mezzanine debt.
All right. So one other thing I wanted, and then we'll move on from this, but just I think Ronny, you brought up a really, really hot button issue for me because I've just been seeing this on everybody's deals, right? So we're kind of talking about maybe some negative connotations around pref, right? And maybe Anton, I'll ask you this question: why do people use pref beyond I can't raise all the money? I would also say it juices the returns in some respects too, right?
Absolutely, right. Yeah. So pref actually has been a common practice in the development world, right? Yeah. Some of the top developers that had the best available names out there, they were able to get, let's say, 75 senior debt, and then they were able to get up to 95, sometimes even more than that, of pref equity on top of it, and their own equity may have been just 5% in the deal. So in development deals, that has always been a common process, and naturally the reason why they have been doing it is because you have to not inject much equity, and by the way, most developers don't have it anyhow, so that's the only way some of these large deals could be done. But ultimately the return, as long as everything goes as anticipated, is extremely large on that 5% that the developer puts into play. Now, with the traditional acquisition deal, it's the same thing, right? So assuming that the business plan pencils out, because the pref equity is capped from a return perspective, right? And it all depends, right? What the GPs are able to arrange. It can be, in best cases, maybe 12% as a total compensation, typically it's more like 14-15%, but it's still capped at that 15%. So as long as a GP you can perform, that money will be repaid with that 15 return, and then the rest will be divided among the GPs and the common equity based on whatever split arrangement has been put in place. And because you have such a smaller piece of equity, the return typically is higher than if you had, let's say, 20% in it rather than 10. Right.
Yeah. So essentially, what Anton's saying is you're juicing your returns because you don't have to bring as much equity, actual cash, to the table, right? And I do agree. I mean, the reason that I think it was in vogue, most developers can't get 75. Most of them are probably more like the 65 range. So they'll layer pref on top of that to get them to call it 80-85%, and then they have to bring the rest, right? So yeah, it was a lot more common then. Now it's becoming more, of just a way to financially engineer deals, and not necessarily a bad thing, but just something that people need to be aware of. But shifting gears, so let's talk about raising equity, Ronny. So kind of going back to what we talked about earlier, right? What are you seeing as far as kind of a shift in your strategy over the last 6 months? Now, obviously, I think you kind of touched on some things, but say somebody's starting off, right, and they're getting into the business right now, right? What has been kind of some new techniques and some new tips that maybe you can share? You don't have to give all your secret sauce away, but, as far as, how are you raising equity in this environment, right?
Yeah, it's building relationships over several years. Right. Let's just say I'm starting over again from scratch in 2022. I would go to every conference, every meetup, everything I possibly can to get my name out there, and then do that online as well. Right. And then every person you meet, schedule a follow-up time to discuss their goals. You're not going to get all of them to, hop on a call with you, but you can get a good chunk of them. And then whenever let's just say, Ben, I go to your meetup, right? And I meet 10 people. Then I write down, okay, I was at Ben's meetup. I met Anton. He's a lender. Here's what he does. He invests in multifamily. He's from Switzerland. You write all these notes down that you know from people on the back of their card. And immediately the next day, or as soon as you get home, type all those notes up. Hey, I met Anton in Houston at this place. And you have all this data, right? Because as you know, as you're growing your team, you have investor relations department, right? They need to know that investor as much as you know that investor. So taking meticulous notes is really, really important. Where do they live? What's their job? Are they an accredited investor? Do they fit your deal profile as far as the type of investors, right? What's your investor avatar, right? So our goal is to get to 2,000 active investors. I found that if you can have 2,000 active investors and raise 50 million a month, 50, you can pretty much buy any deal in the country, right? And that's what I've seen when I've talked to large institutional $1+ billion AUM groups. That's how much, as far as private capital, individual high net worth investors, that's how many active investors they have, right? So you're going to have to hit the streets running, meeting as many people as possible. Not everyone is going to invest with you the first time, but they'll see over time. So it's just, you got to stay in front of them, and you should brand. Every Zoom call I have, every conference I go to, I always wear something with the Kingly Group on it, right? Whether it's a hat, whether it's a polo, or I wear a suit, right? So you have to brand yourself that way. And then making sure you follow up with people. That's critical, right?
I think, and I'll give Ronny some kudos. Ronny's probably one of the most diligent people when it comes to follow-ups. But I mean, so I think in our business, it's so easy to go and pass out business cards and feel like you've somehow accomplished something because you no longer have any business cards, but you have a bunch in your pocket, right? But it's the follow-up, it's the note-taking, it's talking to them after the fact and really building that rapport. Because let's be honest, folks, right? When you're at a networking event, it's chaotic. There's a lot of things happening. How meaningful of a conversation can you truly have, right? And so that follow-up is the key to really kind of pushing that relationship along, and Ronny does a great job at that. So any shift in your approach beyond that, over the last 6 months with just how chaotic the market's kind of been?
Yes, I've shifted a lot, actually. I've been focused really more on the institutional space. I've been going to New York every month, meeting with large private equity groups, literally cold calling them. I've been cold calling private equity groups and been setting meetings. And I also have warm introductions and different things like that. And I'm surprised what type of rooms I've been able to get in, what type of meetings I've been landing, right? Because as the market shifts, all these institutions have the money to deploy, right? And if you have a clear-cut strategy, right, and you have exits on the board, you're able to shift from the private capital into the more institutional capital. So building those relationships definitely takes a lot of time. Always, it's not the first meeting that's most important. It's more of the second, third, and fourth. So I've been shifting a lot in that, and then really doubling down on the individual investor relationships, chatting with existing investors more, chatting with potential investors more, and continuing to go to different events as well. And I've been more selective on the type of events I've been going to. Instead of the more syndicator type of conferences, I'll go to the ones that are local, but I've been shifting into the more institutional ones and trying to build my brand as more of an institutional brand versus a syndicator brand.
No, and I think everybody kind of has that, once you kind of build up enough track record, which direction do you want to go, right? What do you want to be known for, right? Is it more institutional level deals, both in size as well as where you get your equity from? And I think as people kind of grow, they get that, right?
And one thing I'll add is you can only grow as fast as you can raise money in this business.
Mm-hmm. That's true. Yeah, always the cash is king, right? If you can raise the money, you can buy as many deals as you want, right? But Anton, same kind of question, right? What has been your approach to working with lenders and working with your clients? What has shifted over the last 6 months? Aside from obviously the business, how are you going about, the economy, how are you going about the business differently, given just, the chaos in the market?
Yeah, I would say looking back 6 months, it was easy, right? So we had a deal, and then we reached out to our trusted lenders. We got their quotes, and we picked the best from them, right? It was that easy. Now it's more like that we go out to 50 plus lenders, and very often that is not even enough to actually find the right lenders. So in other words, we have to go much broader in our search to identify the ones that where that property and the sponsor actually matches that particular lending group. And while in the past that was much easier to identify those lenders, whoever said yes yesterday to a deal, they may not say yes today, and vice versa. So it's just a much more broader approach initially once you have a deal to find prospective lenders.
So you're saying, okay, so because you had mentioned that, lenders are kind of still there. It's not like the capital markets have completely locked up. Are they just being more picky about deals? Are they being more picky about markets? Are they being more picky about sponsors? Like, what is it? What's keeping a lot of these guys, from pulling the trigger on stuff? Or is it everything?
Yeah, there are a couple of reasons why someone may not do it. Very often it's capacity issues, right? That the timing is just not right, that they want to do it, but because they already have filled the bucket and they haven't gone into the CLO market to sell a pool yet, they need to slow it down. They may have too much in a particular market, but a week ago they still had space for it. So it's very often it's a timing issue. What we also have seen is that most lenders actually have increased their dollar amount requirements tremendously, right? When we look back 12 months or 18 months, virtually all bridge lenders were willing to do 8 to 10 million plus. Now today, we have a situation where lenders that did 10 million 6 months ago, they may now have a requirement of 20 or 30 million as a minimum. And the ones that had 20 or 30 million as a minimum are now at 50 plus, right? And because these changes happen almost on the fly with lenders, that's one of the reasons why we just need to be broader, because we never really know who is right now in the market for that particular deal.
Gotcha. And you had mentioned a term that explain to everybody what happens when these people will lend you money, right? You know, you talked about CLO markets and all this stuff. Can you kind of give a little bit of a breakdown on what is happening with these loans and why it's important for people to understand how this works?
Yes, sure. Right. So obviously there are so-called balance sheet lenders out there. The most traditional ones we know are banks, right? And very often banks actually happen to keep their loans on the bank portfolio, but they may still have other banks participating in these deals. But other than that, the typical bridge lender that is out there that does the majority of all these multifamily acquisitions, their process is as follows, right? So they have some equity and that they can deploy, but then they have a so-called warehouse line with typically with a Wells Fargo, whoever it is. So once they do a deal, Wells Fargo funds a big chunk of that deal, and then that deal is on their book. Then they do the next deal, same way, Wells Fargo funds, and a portion of it goes from their own equity, and it goes on and on and on until they, let's say, have $500 million on their book, and then they go into the so-called CLO market or collateralized loan obligation to find investors that are willing to buy the portfolio of the loans that they just have built up over the last couple of months, right? So once the investors they talk with show an interest, it's being packaged together and it's being sold to them. As a result, it freezes up the warehouse line and it freezes up their own equity, so now they can lend again.
So fun times, right? So, I mean, I think right now, in a lot of ways, you know, because the market's a little bit skittish, if I'm reading in between the lines here, they're being even more picky, the bridge lenders, that is, because they want to make sure that these loans get off of their books, right? They don't want these to be stuck on their books because that doesn't allow them to lend more money. Right. So they're being more picky with the spreads and the deals and the submarkets and the sponsors, because whoever they dump those onto in the CLO market, right, you know, it's probably rated, right, you know, A++, you know, all the way down to junk, right? You know, there's probably a rating system, I'm assuming, right, Anton? You know, some bundles of stuff is going to be better than other bundles.
Sure.
You know, and so, you know, they want it to be as attractive as possible so they can continue to lend money, which is how they make money. Right. You know, and I always thought that was interesting. I think a lot of people, they just don't look past the loan. They're looking, they don't understand how the finance market works. And I think that that's important for people to understand.
Yes. So, what is important also to understand is a lender, when they price a deal today, let's say Ronny buys a property today, the lender quotes on this deal. The lender will go out to various parties and get a sense of where the pricing should be. And because they're constantly in the market, they typically have a sense where it is. Once they close the deal, the challenge is that they do not yet know, once they go into the CLO market, how that CLO market is going to respond to that particular loan, plus all the other loans that they have. So the lender actually takes that risk of keeping it on the book for 3 months or whatever it is, until that portfolio is sold, of the market changing against them. Right?
Yeah. And so shifting gears, right, away from kind of lending and finance world, right? So Ronny, somebody's getting into the markets this year, right? They're 2022 aspiring syndicator, or maybe even aspiring, hey, I want to put some money into a deal, right? I mean, what kind of tips are you offering these people? I'm sure you get hit up all the time. You're all over social media. I mean? Like, let's keep it to the syndicators, right? Somebody wants to come in and syndicate a deal. Are you telling them to wait and hold on? Are you telling them to hop into the market? What kind of tips are you giving them these days?
I'll give really unconventional advice. I would say go work for a larger group that's between 2,000 to 5,000 units. Be a crucial part of their team, and focus on one thing, whether it's underwriting, investor relations, asset management, all that. What I've seen, because I've seen groups literally do this, you work at a big shop. Like, I've seen a group where they literally spun up from a bigger shop and they ended up buying like $6 billion worth of deals. And they were analysts before they started, right?
Yeah.
So I think that's probably the best route to do. But it's hard to get in the door, right? Other thing is like find different programs, go to different conferences, meetups, find ways to co-GP in deals, and know what your skill set is. So if I were to start over again,
Hold on. Yeah.
That happens once in a while.
It happens sometimes, right?
Yeah, there's always somebody out there trying to crash in.
Yeah. All right.
We had people sending sex sites out on one of them, on Vinky's.
Don't give anybody any ideas now, all right? But anyway, so yeah, sorry, Ronny. All right. So you're saying, hey, at the end of the day, you want to, kind of give some people advice. You're saying, hey, maybe go work for a bigger shop, learn the ins and outs of the business, and then go out on your own, right?
That's the best way, because you're getting paid to learn, right? What's another better setup, right? Because building like a real estate private equity platform is very capital intensive, right? So I think that, and it depends on your goals, right? Like, if you're just trying to do deals and just do a bunch of deals and co-GP, that's fine as well. But I think you just got to break down and see what your goals are, and then talk to people who have real experience. Like, let's say, Ben, you're a guy I know in Houston. I want to break into Houston, right? I'll have a conversation with you. Hey, which markets are good? Which markets are bad? Why do you like this part of town? Why don't you like this part of town, right? Pick 5 markets and then five different operators that have units in that market, and find a way to sit down with them and also add value. Because you can learn markets pretty quickly, I think. We've grown in Texas, Georgia, and North Carolina. So every single time we break into a market, that's the process.
Yeah. No, and I think you hit it on the head when you said, add value, right? Because that could be for, when you're starting off and you just want to partner with somebody, or you're starting off and you want to work for somebody, right? You ultimately, it's all a transactional thing. You have to add value to the transaction. And I think that's important for people that are starting off. You want to be a syndicator, right? Even if you've got the money, and I know a lot of affluent people that get into this business. I'm sure there's some of them are on this call right now, right? But just because you have the money there's a fair amount of risk in what we do. So get yourself educated first, partner with people that can kind of make you, allow you to avoid some of those landmines that could potentially ensnare you, and go out and add value to folks, right? I think that's important. But Anton, kind of similar question, right? Somebody's getting into the business, not necessarily from the loan side, but you obviously talk to a lot of syndicators, you talk to a lot of owner operators. What kind of advice would you be giving them right now?
Yeah, so you ask, Ronny, right? What advice would you give that 22-year-old, right? I've other than working for someone, right? I would say everyone hears obviously the pitch for 10x, 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 right? You need to be a GP, you need to be a GP. It just never ends, right? This is all nice and dandy. I think what everyone who is aspiring to this really needs to understand is, as a GP, yes, there is some acquisition fee, and yes, there is some asset management fee, but you do not make money for you personally so that you can make a living unless you have a massive amount of deals under your belt running, right? And I think that is probably one of my main advice to someone who thinks to start out, and even the ones who attend all these coaching seminars and all that, where they're pumped for, you need to be a GP and to be a GP. Unless you belong to that affluent group that you are mentioning, just be aware that there is no paycheck coming in for a long time that is of any substance.
Yeah. All right. So I want to end this on a positive. I think we've spooked enough people, or at least maybe level set some folks tonight. Right. So, and at the end, I'm going to give my answer to this question. Right. So what is 2 positive things that you still love about the multifamily industry right now, despite everything else that's happening? Anton.
Well, I've been loving multifamily since I started out, right? So I've been involved in various commercial real estate. I still love multifamily the most. What I love about multifamily is that you actually can add value very quickly to a property. You just do not have that ability, other than maybe self-storage and a similar type of short-term rentals. But that is really the only way in large commercial real estate where you have that ability. In the current environment, talking about the rent increases, that's massive, right? So you have the ability to actually improve your top line very quickly with these increased rents. You do not have that with office buildings. And you do not have it with retail or industrial even, right? That's another darling in the space. So that is what I really love about multifamily. And the other reason why I love multifamily, despite all the rental control discussion and all that, there is a real need for housing. No matter where the economy is going, there is always a need for housing.
That's true. Same question, Ronny. 2 things you love about multifamily right now.
I would say right now, we're looking at one of the greatest buying opportunities in multifamily. This feels very similar to COVID, and we all were there. We all owned during COVID, and how everything slowed down for a small amount of time. That was a very short blip. This, I feel like there's a longer runway to pick up deals at exceptional basis, right? If you're buying deals with relatively low leverage and have flexible debt, I think people are gonna do very well, right? And then obviously have enough reserves. So I mean, we've been seeing an incredible amount of opportunity, nearly 1,000 units in the pipeline, either closed or under contract. So it's been pretty wild, right? It went from 0 to 100 like very, very quickly. I think we'll probably end up close to 2,000 units acquired by the end of the year. But it's just right now is the opportunity, not only as a GP, but also as an LP. Inflation's going to continue to be here, right? We don't know what's going to happen with the Fed meeting next week and stuff like that. But multifamily, I believe, is one of the best places to park your money, especially the deals we're buying are, significantly under replacement cost, right? You can literally not build B and C class multifamily. So I think there's a very, very unique opportunity to be able to create wealth and preserve wealth, either on the GP side or on the LP side. So I'd love to hear your perspective, Ben.
No. I mean, you guys both kind of stole some of my answers. So, but I love the supply and demand imbalance that's happening right now in some of the markets that we invest in. North Carolina, Florida, Georgia, Texas. There's so many people flooding into these markets, folks, and there's just not enough housing. And right now, the other thing that's kind of to build these properties is becoming more and more expensive. So, the B and C stuff is going to become more and more valuable. Even if we feel like it's pricey, the rents that you're still charging are significantly less than what a new build's going to have to come out to the market with, because they're going to have to keep up with all the inflation that's going on with materials and labor and all that other stuff, right? So what am I saying here, folks? What I'm trying to say is that there's too many people moving into these markets. There's not enough housing. There's a supply and demand problem. That's good if you know what you're doing, right?
My pussy hurts a lot. Oh my God.
Fucking Jesus Christ.
Ben, another thing I'd like to add is like for class B deals, if you're capitalizing them well on rehab, you're doing the tile backsplash, the quartz countertops, new cabinet boxes, you're redoing everything, right? If you have a well-capitalized B-class deal, that's gold right now, because not many people can afford houses, right? And not many people can live in the shiny class A deals. So if you capitalize these B-class product and you're still well under replacement cost as your total cost basis, that's very good, not only from an operator like GP perspective, but also as an LP, you're in the money, right? So, and you have to capitalize the deal as well to make sure you hit that appropriate rent bump.
Absolutely. So and so those are some of the reasons why we love it, folks, right? Yeah, there's still some choppy markets. I think that's the consensus here, but there's still deals to be had. And one other thing that Ronny kind of touched on, right? If you've got enough dry powder, if you know what you're doing, these brokers are clamoring for people to put offers in on these deals. I mean, they went from getting 30 offers and 20 people invest in final to they're at 5 offers and they're hoping somebody gets them the good offer. Right. It's literally the buyer pool has kind of dropped off a cliff, and it's not necessarily mean that the fundamentals are bad. I think just a lot of people, there's just this market sentiment that let's wait and see. Sometimes that can lead to an opportunity too. Right. Just like Ronny mentioned in COVID, everybody for the most part stopped. We did included. But I still to this day, 2 years later, say that was the biggest mistake that Disrupt Equity made, was to stop buying. Right now, there was a 2 or 3 month that everybody stopped buying, but after that, we should have ramped back up, and we just didn't because we weren't quite sure. We were trying to stay in the sidelines. Well, guess what? Everybody that bought in the back half of 2020 and the front half of 2021, they're in the money on almost everything. So it's just something to kind of take into consideration. But I want to open it up to open Q&A. Sorry for some of these people that like to get on here and spam people, folks. It just kind of happens. But I did want to point out one question that we had earlier, and I'm gonna tell Anton to get out his crystal ball, right? What do we think the Fed's gonna do? When they come out and they talk about raising rates.
75 is already a given. It's only a question whether it's 75 or 1%.
Well, you got to pick one. Which one are you picking?
One.
Ooh, okay. All right. They're trying to. What do you think?
I would say 75 basis points is the base case scenario. I do think Jerome Powell, is going to be very, very aggressive these next few months. And I'd be interested to hear your perspective, Ben, because y'all been doing a lot of transactions lately, right? What's been your perspective on this? And then how are you timing these deals when it comes to every Fed meaning something different's happening on the buy and sell side?
Luckily, a lot of this stuff is already baked into the market. Like you kind of know what's going to happen, right? Like there was no scenario like that's like going to trip us up for the last 2 or 3 months, because like every day they're talking about Jerome Powell and the Fed and interest rates and inflation. I mean, it's like the news cycle can't get enough of this stuff, right? I'm leaning towards 75 basis points. Maybe that's just the optimistic syndicator in me, but at the end of the day, you've got to kind of have these worst case scenarios, right? And I think one thing that we didn't touch on today was, there's a lot of bridge debt out there. There's a lot of balance sheet debt out there, but there's interest rate caps too. And, what is that for people that don't understand what that concept is? It's just essentially a hedge, right? So, my interest rates can't just like spike to 10% if, Jerome Powell tomorrow says, I'm going to jack it up 500 basis points, right? It hits that cap, and anything above that, it's going to pay, right? I'm in the money up here, right? And so that's what ends up happening, with a lot of these. And so, at the end of the day, I think you can't time the market. If you do, or if I did, I'd probably be a lot more wealthy. But, at the end of the day, you just have to work with what right now, the best information. That's why we surround ourselves with people like Anton, and some of our other team, because they can kind of give us advice as to how to position these things too. And I would say the one of the best things that we're seeing right now, still a little hard to work with, is the local and the regional banks. Their spreads are significantly better than the bridge lenders are right now. So now they're really, really busy because everybody's found them out again, and now they're back in vogue. But their spreads are significantly better, and something to kind of think about. Another question that kind of came in, Anton, this is another one for you. Will loans now be sold as conduit?
Well, that's really what we are talking about.
CLO market, right?
CLO, right?
Yeah.
It's just different naming convention there. Right?
Okay. All right. So what are some of the driving factors to improve the profitability and appreciation of multifamily? I think I'm a big proponent of the best way to force appreciation on these is to drive revenue, right? And so that means increase rents, increase other income, right? People get real short-sighted on trying to manage expenses. I think right now that's really, really problematic, right? I mean, let's just be honest, taxes and insurance are always going up. That's always been the case throughout my entire career. Well, now labor's going up. Now materials are going up, right? So how do you offset that? You've got to increase rents, right? So always be looking at the revenue side. That's probably the easiest way to kind of force appreciation, right? Somebody asked about it. Go ahead, man.
I would add one other thing. As you're doing that, make sure you capitalize the deals well,
Yes.
Because like 2020 till now, I didn't think the world would look like this, as far as like how much things have gotten more expensive and different things like that. So as you're buying a deal right now, make sure you're very capitalized when it comes to reserves, very capitalized when it comes to your rehab. Make sure you have enough buffer to where it's the inflation buffer is like what I like to call it. You have that and you do high quality upgrades on your property, you're going to do fine.
Absolutely not. I think reserves are king. They were always important, but they're even more important right now because obviously the market is a little bit choppy, right? We don't know really what could potentially happen. It's good to have some reserves. Trust me, your LPs will thank you. All right, so I'm just kind of going through this. What other potential multifamily hot markets are out there in addition to Texas, Georgia, North Carolina? How do they compare to these existing states? I would add Florida to it. I mean, a lot of people like Arizona as well. I think that's kind of some pockets are probably a little overheated out there. Hell, some people would probably say some pockets of all these markets are overheated. But why do people like these markets, folks? Well, it's because people are moving there. Jobs are moving there. They're typically tax and business friendly, right? Landlord friendly. Those are all conducive to profitable business endeavors, right? So, I would probably again add Florida. I'd add Arizona. I don't know, Ronnie. What else would you think? I think Tennessee, maybe.
Yeah, I mean, I would say look at where the activity is, right?
Yeah.
Like obviously Texas, Georgia, North Carolina. Those are our markets. Florida. If you just look at the Sun Belt region, I typically like red states in the Sun Belt region. I feel like that is like the best type of market as far as like not being able to evict and different things like that. It's very landlord friendly. So that's what I like. But everyone has different opinions on it, and I think you have to find your markets, find 3 to 5 markets, and research them and find operators in them and start seeing the deals, right? Because you won't understand the deal until you start seeing them, and then you start going and visiting, right?
Yeah.
So that would be my tip.
Yeah, I mean, look up the definition of Sun Belt states. I think that's probably the best way to describe it, right? I mean, Victor was asking Gulf Coast up to North Carolina. I mean, I think that's also inclusive of some other states along the way too, right? I mean, that Sun Belt is really literally a thing, and so take a look at that. People, and I used to live in California. And I always like to knock on California. I mean, it's a great place to live, beautiful. You got the beaches, best weather, get it. I would never invest in multifamily out there because it's not tax friendly, it's not business friendly, it's not landlord friendly, right? And there's they don't even know what cash flow is. It's like investing in Manhattan. You're just hoping that it appreciates enough that you can actually make some money at some point, right? We consider ourselves, and everybody that's on this panel likes cash flow, right? And the only place that you're going to get that right now is Sunbelt. Right now, and maybe some Midwest markets too. So I won't name all of those, but there are some of those out there. But you're not going to get the appreciation in the Midwest markets that you're going to get where we're at, right?
I think another thing to add is like knowing how the expenses are in each of the markets. That's very critical as far as making like investment decisions. Like Texas is completely different than Arizona as far as expenses, right? So, if you can know the difference, then you can know, why is the pricing so much higher in Arizona than it is in Texas? That's because the expenses are 20% lower in Arizona, right? But there's pros and cons to both the markets, right? So that's just something you have to think about as well.
Yeah, having local boots on the ground partners, whether it be a property management company or physically a partner that's out there, is invaluable because these things swing even within Texas, right? My labor is going to be different in Austin than it is in Houston than it is in DFW, right? So don't even look at it from a statewide level. You got to look at it in a market level, and you really need to know that data. And the only way you can get that is people that have done business there. So that's a really important. That's a good distinction too.
I see. Tom had a question on like just structures for like GP LPs for larger deals. Ben, you want to talk about like how you normally structure it?
I look at it like this, right? You can structure a deal as long as it's legal any way that you absolutely want. You can do a 99-1 split with your investors, right? If everybody's agreeable to it, right? I say typically you're going to see anywhere from, I've seen it on the low end of 80-20, 80% going to the LPs, 20% going to the GPs, all the way to seeing 50-50s, right? I've seen even, more in favor of the GPs on certain things too, but that's probably on the most extreme case is 50-50, right? Some people do preferred returns, some people don't. What is that? Well, you have a preferred return that's based on the equity that you raise, right? So if we raise $1 million, I'm giving you an 8% preferred return annualized. That means I'm paying out the first $80K to my investors. Then above that, there might be some kind of a split, right? But, at the end of the day, study the PPMs that you guys are going to be signing. That's important. There should all be disclosed there, and you need to understand it. If you don't, you need to ask the question. Right. But, I think it's ultimately, what are your LPs willing to accept? I won't name any names, but we know some people that are in different parts of the country that, man, I'm just blown away that their investors would expect that accept that, because that's just not what my LPs would. They wouldn't take it. Right. We have some syndicators that are doing stuff that's structured as just straight debt. Right. All they're doing is just raising the money, and they're giving these people 7-8%, and they're happy. Right. There's no upside. My LPs would, put, my head on a pitchfork if I tried to pitch that deal. But this guy, he owns thousands of units. And so, again, I think it's, just dependent on what your investors are willing to take.
Yeah.
You know, and what they can perceive
I
as a good
agree.
deal. No.
And I think LPs need to study what's actually market as far as like returns, right?
Yeah.
In my opinion, you can't produce an 8% cash on cash return in year one on deep value add deals, right? You just can't.
It just doesn't make
It's
sense.
like maybe a class A deal, right? You could probably get anywhere from 2 to 5% cash on cash, maybe, you know? So that's just another thing to think about is like the expectations when you're investing. Find out as you're structuring the deals, like let's just say, Tom, you have 100 people, call all 100 and ask them, hey, what type of cash on cash returns are you looking for year one, year two, year three? I talked with one of the largest multifamily operators in the country. He's one of the co-founders. They have 40,000 units. And I asked him, hey, you're a large fund. You just went public. What is your expectations for LPs? Because they still raise private capital as well. But they have like $1 billion fund, and the first 100 million is all individual LPs, like 6,000 investors is active. And what he said is like the first 2 years are anywhere from 2 to 3% cash on cash. So I'm like, I find that interesting from a group that owns 40,000 units.
Yeah, they might know a thing or two, right? You know. All right, so I'm going to rapid fire this because I want to get to the breakout rooms here, right? So, all right, so where's the better state for property taxes? You know, and I think Nate, you kind of can't usually states with a state income tax. Typically, right? You know, some states are more aggressive than others. Some revalue properties on an annual basis. You know, I think in Tennessee, I think it's like every 4 years, right? So just you have to look at and you know get to the advice of a tax advisor on that stuff. You know, but I would not base that as one data point amongst a lot of different data points. You should not base your where you're going to buy deals at based on the property tax situation there. Right. Tom, you also asked, you know, what's the kind of the timeline to sell? Typically, you're anywhere from 3 to 7 years. It's typically in our business, right? Now, I've seen it shorter. I've seen it longer. That's typically the sweet spot is 3 to 7 years. People don't like to have their money tied up longer than that. And as Ronny just pointed out, you know, anything less than 3 years, you might not be able to get the full potential of the deal. Right. You know, I mean, it's just been a hot market the last few years. So people are selling for less than 3 years, but most of the time it takes that long to get through the rehab and just, you know, kind of increase rents. All right. So I'm just kind of trying to see. Yes, we're going to have a recording of this. All of these are recorded. They will be sent out. And is a hot multifamily market now and rightly so solid fundamentals. Yeah, it is, you know, but hey, just wanted to thank my fellow, you know, co-hosts, Ronny Phillip, Anton Mattli, their contact information. I think they both put it into the chat. Go ahead and save all that, folks. There was a lot of good people here on tonight. I did want to invite everybody to do a breakout room. So this is kind of where we do some networking for the night. Me, Ronny, and Anton will all hang around. We'll do some networking with you. I'll probably put a 15-minute timeline on it. You know, just kind of see who's left, you know, when we come back around, but would love for you guys to stay around. If not, you know, we will be back the second Wednesday of every month doing these, and we'll try to have some good speakers and some good panels along the way, but we appreciate you guys tuning in. So bear with me here. Hopefully I don't muck this up. Go ahead,
another
bud.
thing I'd like to add, John Monteiro, he's also a co-host on this meetup. So he wasn't able to make it tonight. So he has a Facebook group called Texas Multifamily Investor Network. So be sure to connect with him on there as well.
Yeah, John's a great guy. Feras Moussa is my business partner. He wasn't here tonight either. You know, so we'll all be back in full force hopefully next month. But again, thanks everybody for tuning in.